Auditing Standard SA 320 Part 1. Determining materiality and performance materiality when planning the audit. Auditing Standard 320 focuses on the concept of materiality in the context of an audit of financial statements. Materiality refers to the level at which a misstatement or omission in the financial statements could influence the economic decisions of users of those statements. The auditor's responsibility is to apply the concept of materiality appropriately in planning and performing the audit, and in evaluating the effect of identified misstatements on the audit and of uncorrected misstatements on the financial statements. The financial reporting frameworks generally discuss the concept of materiality and provide a reference for the auditor in determining materiality. If the applicable financial reporting framework does not include such discussion, the characteristics of misstatements and judgments about matters material to users of the financial statements serve as a frame of reference. The auditor's determination of materiality is a matter of professional judgment and is influenced by the financial information needs of users. It assumes that users have reasonable knowledge of business and accounting and make economic decisions based on the information provided in the financial statements. Materiality is applied in planning and performing the audit, evaluating the effect of identified misstatements, and forming the opinion in the auditor's report. It is considered throughout the audit, particularly when identifying and assessing the risks of material misstatement and determining the nature, timing, and extent of further audit procedures. Materiality levels for particular classes of transactions, account balances, or disclosures. The auditor makes judgments about the size of misstatements that will be considered material during the planning stage. These judgments form the basis for risk assessment procedures, identifying and assessing risks of material misstatement and determining the extent of further audit procedures. The standard provides a definition of performance materiality, which is the amount set by the auditor at less than materiality for the financial statements as a whole. It aims to reduce the probability that the aggregate of uncorrected and undetected misstatements exceeds materiality for the financial statements. The process of determining materiality involves exercising professional judgment and considering various factors such as financial statement elements, the nature of the entity, its ownership structure, and the industry and economic environment in which it operates. Relevant financial data, including prior periods' results, budgets, and forecasts, should also be considered. Certain classes of transactions, account balances, or disclosures may have materiality levels different from the overall materiality for the financial statements. Factors such as legal requirements and industry-specific disclosures may indicate the existence of such classes. The auditor should determine a performance materiality level for these classes to assess the risk of material misstatement and plan further audit procedures. By considering these points, auditors can effectively determine materiality and performance materiality, and ensure that their audits provide reliable and meaningful information to users of financial statements. Thanks for watching.